Welcome to the Founders Journey podcast. Inspiration, education for founders by founders.
Hey, Greg Moran here from Evergreen Mountain Equity Partners and Evergreen Growth and the Founders Journey podcast. If you're a startup founder, you're looking to raise venture capital, or you simply just, maybe you're an LP or potential LP, meaning an investor in a venture capital firm, and just want to understand how VC funding actually works, you're in the right place. We're going to talk a little bit about how to break down your company's startup valuation and why it's really critical for your startup journey. This is a really tricky topic. I know over the years I've struggled with this myself as a founder because it's easy to really undervalue yourself, but it's also really easy to overvalue yourself. And kind of finding that right balance is a really, really tricky thing. So we're going to talk about that a little bit today. So first, I want to take a quick look at the venture capital funding process itself. VC funding typically starts with smaller rounds, may not even be a VC. A lot of times you hear the term friends and family, and that's exactly what it sounds like. Angel investors, you may have heard that. Those are usually individual investors that invest in private companies. And it starts with smaller rounds, like a seed round or even a pre-seed round. You may have heard that term before. And really what that means, it's really early stage. And typically from there, you move on to a Series A round. Series A is just like kind of the starter round for VCs to start to scale the company. We'll talk about that more in other videos as well. And a lot of times you'll progress through kind of the alphabet soup of funding. Series B, C, so on. Sometimes you'll hear D, E, things like that. At each stage, your valuation really plays a key role in determining how much money you're going to need to give up as the founder in exchange for that investment. And it's a really interesting thing because if your business really starts to grow and scale, it can mean millions or tens of millions or hundreds of millions of dollars in long-term wealth creation for you down the road. So this is an important thing to really understand. So when we say the term valuation, in simple terms, it's the estimated worth of your company. So this can either be determined before or after a funding round. So those two terms are known as pre-money and post-money valuation. So let me break that down further because that can be a little bit complicated. Simply, pre-money valuation really refers to the value of your startup before any investment is added. Okay. So if I believe my company is worth $10 million today and nobody's invested, it's worth $10 million. That's my pre-money valuation. Post-money, on the other hand, is the value after the startup, after the investment has been made. So a quick formula for this is really pre-money valuation plus investment equals post-money valuation. So just to give a really quick example, in that scenario where I thought my company was worth 10 million, and maybe somebody invests 2 million into my company and agrees with me that it's worth 10 million, my post-money valuation is 10 million, pre-money, plus the investment, 2 million, post-money, 12 million. Okay. So we'll talk about why that's really important, why those two things become really important, because they really have a lot to do with the equity distribution. There's a lot of factors that influence your startup's valuation. This can include market trends, financial performance, strength of the team is a big one, product development, competition. All of these things are what I, as an investor and any investor, really look at to gauge the potential long-term success of your business, because ultimately as an investor, that's what I'm betting on, the long-term potential of your business. There are very few short-term gains to be had in the venture capital world. So there are a few ways to calculate your valuation. These are really, you can really go down the rabbit hole here. So I would try to understand these, but I'm going to tell you right now, make sure you've got a really strong financial advisor, an accountant who's done private equity type venture capital deals before, and a great lawyer. These are not things to skimp on. Do not go with the lawyer who, represented you in the purchase of your house or, or got you out of a traffic ticket. You want to go with lawyers and accountants, advisors here who really understand, because a small mistake up front can cost you millions in the long run. Don't be cheap here. So now I'll get into it a little bit. So there's really kind of a lot of ways. to value a company, that investors will use to value a company. Some of the most common ones, there's really kind of three really common ones. You'll hear different names for these sometimes. First is discounted cash flow. And that means really what it's doing is it's estimating the future cash flow of your business and then discounting it to the present value. There's a lot of formulas for doing this. It can be really complicated calculations, but it's basically how much money do we believe, how much cash do we believe your business will throw off in the future? And then we kind of bring that back and say, okay, what's the value of that for me worth today? Because it's going to be worth less for me today than when it's actually realized in the future, because there's risk, right? It may not ever get realized. Second one that's fairly common is a comparable company analysis. And what that means is you're really comparing your startup to other companies in the market. Now, you see this a lot in hot markets where there's a lot of competition for deals. You're seeing this today in AI, some other sectors, climate tech. You're seeing this as well. So when you have other similar companies that are similar size, you can look at the valuations of those companies and say, okay, what's the market paying for those companies today? What are investors paying? How do they value, based on the similar size, similar space? And then the third is what we call the venture capital method, right? Not very scientific way, not very scientific name, but really what you're doing is you're estimating the long-term exit value, and then you're working backward to determine the current value, okay? So if we believe that the long-term value on a company is going to be $1 billion because there's this massively growing market, there's huge macro tailwinds, the timing is perfect, we're going to pay more for that as a venture investment than maybe something that is a great business, but maybe it doesn't have those kind of macro tailwinds behind it, right? Again, AI is a good example of this. You see venture capital firms paying really high rates because there's a ton of market momentum behind them, and there's a belief that the exit values can be really, really strong. And then they'll work back and they'll pay more today for that long-term potential. Whereas, in other areas, you may not have quite that kind of long-term potential. Quite honestly, I've always started businesses that were not the hot companies in the space. I spent my career in HR technology and sales technology, and these were good spaces. These were really good markets. But the long-term exit value probably wasn't as high as other areas where like fintech or climate tech or AI or something like that are today, right? So VCs were willing to pay less. That was okay for me, right? And you don't have to be in the hot space. But understanding that long-term exit value and then working back is that venture capital method, which is really that kind of third common method. Again, you'll hear different terms. Each method has its pros and cons. The one that's right for you is going to depend on your specific situation. Again, advisors will help you understand this. VCs, again, will kind of help guide you in this area as well, because ultimately your startup valuation is what an investor is willing to pay for it, right? Just like anything else in life. So your valuation is really critical because it directly impacts how much equity you have to give in exchange for an investment. So I'll give you an example. You have a pre-money valuation. Let's say your pre-money valuation is $5 million, okay? And you go out and you raise $1 million. Again, let's go back to that formula. Pre-money, 5, investment, 1, pre-money plus investment equals post-money, 6, right? What that means is that the investor is going to receive about 16.7% equity in your company. 1 divided by 6. Right? That's how you're determined. That's the equity, because the percentage. Now the common mistake people will make is to say, well, I'm giving up 20%, 1 divided by 5, my pre-money. No, you're giving up the investment divided by the post-money is the actual equity dilution that's taking place. Important to understand these things. So when you're negotiating your valuation, you can negotiate these things, right? Because little changes can make a big difference. That 5 million pre-money, if you could negotiate 6 for that million, makes a big difference. 1% can mean an awful lot in the long-term equity, in the long-term value of your company. So you can negotiate these things. And when you're negotiating that valuation with investors, you really want to keep a few things in mind, right? Number one, know your worth. Be confident in your business and potential. But number two, you got to be able to back that up, right? So use data, use projections, but also understand what the market is paying for similar kind of companies. Again, I talked about those 3 valuation methods. If you really want to get technical about it, you can try to figure out what you think you might be worth on a discounted cash flow. But if you just use the other 2 simple methods, what are market comps in your space for your size company? And what do you believe the long-term exit value? Be realistic here, right? The chances that you're going to build a multi-billion-dollar company, not saying it's impossible, but it's probably unlikely compared to your ability to, say, build a $100 or $200 million company, right? Be realistic. You want to shoot for the moon, have high expectations, but you do want to be realistic and be able to back up your notion of what you believe you're worth today. And then really be open to feedback is the other tip. I've seen founders enter into these things and say, I'm worth $100 million and that's it, and I'm not taking a penny less. And you know what ends up happening? They don't raise money. That's a problem. Or they just lose credibility, right? Investors may have a very different perspective. So be open to adjusting your valuation based on the input that you're hearing from the market. Don't be so rigid in your stance that you can't grow your company because you can't get the money raised. That doesn't do anybody any good, right? So be realistic, back it up, know your worth, and then be open to the feedback you're getting from the market. So valuation, it's a really critical step. It's a really critical part of the funding process. Getting it right can make all the difference in your long-term fundraising success, and more importantly, your long-term growth of the company. So if you found this video helpful, give it a thumbs up, share it with other entrepreneurs that are thinking about the VC world, or maybe you're other people that are thinking about making investments in venture capital firms. Don't forget to subscribe to this podcast channel for more insights in venture capital and in business growth. I'm Greg Moran from Evergreen Mountain Equity Partners and Evergreen Growth. Appreciate you joining me today. We'll see you next time.